Every investment comes with risk, but in commercial real estate, knowing how to spot those risks before they hit can save you time, money, and stress down the line. Smart investors don't just hope for the best, they prepare for the worst and build strategies that keep them ahead. Let's get started. When we think about investing in property, we usually imagine the rewards: passive income, capital growth, a stronger portfolio. But here's the reality: every investment comes with risk. And in commercial real estate, those risks can be bigger and more complex than in residential property. So today, we're going to talk about how to identify those risks early and how to protect your investment with smart, proactive strategies. In commercial real estate, risks come in many forms. Some are market-related, others are financial, some are operational or tenant-related, and a few, like a global pandemic or economic crash, come completely out of left field. Here are some of the most common types of risk you need to watch out for. Market risk. This is the big one. Property values fluctuate depending on demand, interest rates, and broader economic conditions. If the market dips, your property could lose value or sit vacant longer than expected. Tenant risk. In commercial property, your income usually depends on a few key tenants, sometimes just one. If a major tenant defaults, leaves, or negotiates lower rent, your cash flow could take a big hit. Interest rate risk. If you financed your investment with a mortgage, rising interest rates can increase your repayments and eat into your returns. This is especially risky if your loan has a variable rate or short-term fixed rate. Liquidity risk. Unlike stocks or bonds, commercial properties can't be sold quickly. If you need cash fast, selling a commercial asset might take months, and you may have to lower the price to attract buyers. Regulatory risk. Changes in planning laws, zoning rules, environmental regulations, or tax codes can impact your property's value or development potential. This is especially important if your investment depends on future redevelopment. Operational risk. Things like maintenance issues, rising utility costs, or poorly managed contractors can lead to unexpected expenses and lower tenant satisfaction. Location-specific risk. Even within a growing city, some areas may decline due to crime, poor transport links, or changing demographics. What looks like a hot area today might be underperforming tomorrow. Now that we've identified the major risks, let's move into mitigating financial and market risks. The good news is that while you can't eliminate all risks, you can absolutely manage and reduce them with the right strategies. Here's how. First, do your research. This seems obvious, but too many investors skip the deep due diligence. Understand the local market, vacancy rates, rental trends, future infrastructure plans, and economic indicators. This helps you spot red flags early. Second, diversify your portfolio. Relying on a single property, tenant, or asset class makes you vulnerable. If one office tenant goes under, but you also have logistics and retail assets in different locations, your overall income stays stable. Next, build strong lease agreements. Negotiate clear, protective terms. Long-term leases with reliable tenants reduce volatility. Look for tenants with strong financials, ideally national brands or businesses with long operating histories. Another tip, consider fixed-rate financing. If you're borrowing to purchase property, a fixed-rate mortgage protects you from interest rate hikes. Yes, you might pay slightly more upfront, but the stability can be worth it. Don't forget to create a cash reserve. Having a buffer, say 3 to 6 months of expenses, can help you cover vacancies, repairs, or unexpected costs without panicking or selling at a loss. Also, consider insurance as a powerful risk management tool. Property insurance, loss of rent cover, liability insurance, all of these can protect you when things go wrong. Speak to a broker who understands commercial property to get the right coverage. And finally, stay informed. Commercial real estate is constantly evolving. Whether it's new tax laws, energy efficiency regulations, or tenant demands, staying current helps you adapt early and avoid getting blindsided. One more bonus tip: work with professionals. A trusted solicitor, a savvy broker, and a good property manager can help you spot and solve problems before they become costly. Don't try to go it alone. Surround yourself with people who know the game. So, to wrap up today's episode, investing in commercial real estate isn't just about chasing returns. It's about managing risk wisely. The most successful investors aren't the ones who avoid risk altogether. They are the ones who understand it, prepare for it, and respond to it strategically. That's it for today on Eggs Invest. I hope this gives you more confidence to step into the commercial space with your eyes open and your strategy strong. In our next episode, we'll be talking about property valuation and due diligence, how to know what a property is really worth, and how to make sure you're not buying into a money pit. And this is Eggs Invest, where smart investing starts with smarter decisions.